Hey everyone, and welcome back. Today we're going to be doing a deep dive into the world of finance.
Ooh, finance.
Yeah, it can be a little intimidating for a lot of
Oh,
people.
yeah, definitely. A lot of people are very intimidated by finance.
Right. But we want to make it fun and accessible for everyone.
Absolutely. And there's no better way to make finance fun than with a game.
Oh, is there a game?
There is.
Tell me about the game.
Well, our guide for this journey is Mihir Desai's book, How Finance Works.
Okay, cool.
And in this book, he actually uses a game to teach some really important financial concepts.
That's awesome. I love when learning is disguised as a game.
Me too. And this one's a good one. It's called the Unidentified Industries game.
Okay, the unidentified industries game. I like it already.
Yes, so we're going to be analyzing real financial data from 14 different companies.
Okay,
But the catch is their identities are hidden.
so we're like financial detectives.
Exactly. As we go through the book, we're going to use what we learn to try and crack the code and figure out who's who.
Oh, that's so cool. I love a good mystery.
It's going to be fun.
Okay, so before we jump into this financial mystery, we should probably make sure we're all on the same page with some of the basics.
Yeah, good point.
When we talk about finance, we're often looking at financial statements.
Right.
And I know those can seem kind of like a foreign language to a lot of people.
Totally. It's like trying to read hieroglyphics sometimes.
Right. But really, they're just a way for companies to tell their financial story.
Yeah, they're like the chapters of a company's financial biography.
Okay, I like that. So what's the first chapter in this financial biography?
So the first chapter is the balance sheet,
The balance sheet.
which is essentially a snapshot of a company's financial health at a specific point in time.
Okay.
It shows what the company owns their assets,
Okay.
things like cash inventory or even buildings.
Got it. So there's stuff.
Exactly. And it also shows what the company owes.
Oh, they're debts.
Yeah, their liabilities, things like debt or payments due to suppliers.
Okay, so one side is what they have, the other side is what they owe.
Precisely. And the difference between those two, that's the shareholders' equity,
Equity.
which represents the owner's stake in the business.
Okay, so if we were looking at, say, Starbucks's balance sheet, we'd see their assets, the value of all those coffee beans they've got piled up, and their liabilities, maybe any loans they've taken out to open new stores.
Right.
And what's left over after subtracting those liabilities from the assets, that's what belongs to the shareholders.
You got it. Now, the second chapter in our financial story is the income statement.
Okay, the income statement.
And this one's more like a report card.
Okay.
It shows how the company performed over a period of time.
So it's less of a snapshot and more of like a movie.
Exactly. It tells us how much revenue the company generated its costs
Okay.
and ultimately the profit it earned.
So for Starbucks, it would be how much money they made from selling all those lattes, minus the cost of the coffee beans and the rent for their stores and all those barista salaries.
Exactly. And what's left at the end, that's their profit.
Got it. So the income statement is all about profits.
It is. Now, the third crucial chapter in our financial biography is the cash flow statement.
Cash flow.
This statement is all about tracking the actual movement of cash both in and out of the company.
Okay, now I've always wondered about this. Why is there a separate statement for cash flow?
Yeah, that's a great question.
Isn't that already covered in the income statement?
Well, it gets to the heart of why finance is so obsessed with cash flow. You see, profits can sometimes be misleading.
Misleading, how so?
Well, a company can show a profit on paper, but still be struggling if they're not actually generating enough cash to cover their operations.
Oh, that makes sense.
The cash flow statement helps us see where the cash is really coming from and where it's going.
So even if a company is making a profit, they could still be in trouble if their cash flow is weak.
Exactly. It's kind of counterintuitive, but it's true.
Wow. Okay. I'm starting to see why cash flow is so important.
It's like the lifeblood of a business.
So for this unidentified industries game we're about to play, how can we use these financial statements to uncover the hidden identities of these companies?
Well, that's where the real detective work comes in.
Okay.
It's not enough to just look at the raw numbers on the statement.
We need to dig deeper.
We need to analyze them, compare them, and look for clues.
Okay. I'm ready to put on my detective hat.
Good. And one of the most powerful tools we have for doing that is ratios.
Ratio. Okay, now you're really starting to sound like a financial expert.
I try.
Can you break this down for me? Why are ratios so important?
Well, ratios help us cut through the clutter and see the underlying story that the numbers are telling us.
Okay, so they're like a secret code.
In a way, yes.
Ah.
They allow us to compare companies of different sizes across different industries, or even the same company over time.
So it's like having a universal language for understanding financial performance.
Exactly. Instead of just saying company A made $1 million in profit, we can use ratios to say company A is more profitable than company B, even though company B made more total revenue.
Oh, that's interesting.
Right.
So we can make more apples-to-apples comparisons.
Precisely. And when we start looking at ratios, we begin to see the unique fingerprints of different business models.
Okay, so different businesses have different ratio fingerprints.
Exactly.
Cool.
For example, in our unidentified industries game, Desai points out how Amazon has an unusually long receivables collection period.
Okay, receivables, remind me, what are those again?
Oh, yeah, sure. Receivables are essentially the money that a company is owed by its customers for goods or services that have already been delivered.
Okay, so it's like an IOU.
Yeah, basically.
Okay, got it.
Most companies want to collect on those receivables as quickly as possible.
Right, because cash flow is king.
Exactly. So what's unusual about Amazon's receivables?
Yeah, what is unusual about Amazon's receivables?
Well, think about how Amazon works. Customers pay up front when they order something, but Amazon often doesn't pay its suppliers until much later. This means they have a huge amount of cash tied up in receivables, which is quite different from most traditional retailers.
So just by looking at that one ratio, the receivables collection period, we're already getting a clue about Amazon's unique business model.
Exactly.
This game's getting interesting. What other kinds of clues can we find by analyzing these ratios?
Oh, we can uncover all sorts of insights by comparing different companies' ratios, and that's what we're going to do next.
Awesome, I can't wait.
So, for example, let's look at inventory turnover.
Inventory turnover.
This ratio tells us how quickly a company sells its inventory.
Oh, okay. So a higher inventory turnover means they're selling their stuff faster.
Exactly. Now, in our unidentified industries game, Desai compares Yum brands.
Oh, man.
Yeah, the parent company of fast food chains like KFC and Taco Bell,
Okay, got it.
with a company like Nordstrom, a high-end department store.
Okay, so fast food versus fancy clothes.
Right, and you can probably already guess which one has a higher inventory turnover.
I think so, yeah. Fast food restaurants go through a ton of ingredients every day, so I'm guessing they have a much higher inventory turnover than a department store.
You nailed it. Yum. Brands needs to move ingredients quickly to keep things fresh.
Yeah, for sure.
While Nordstrom's inventory, like designer clothing and shoes, tends to sit on shelves for much longer.
Right, they don't have to worry about their inventory going bad.
Exactly. So just by comparing this one ratio, we can start to picture how these different businesses operate.
That's really cool. It's like being able to peek behind the curtain and understand the inner workings of their businesses.
That's the power of financial analysis. And speaking of powerful tools, there's another important concept that Desai introduces, the DuPont analysis.
The DuPont analysis, okay, that sounds intense.
It's not as scary as it sounds, I promise.
Okay, good.
This framework helps us dissect a company's return on equity, or ROE.
ROE.
Which is a key measure of profitability.
Okay, I'm familiar with ROE, but what is this DuPont thing and why do we need, isn't ROE enough on its own?
Well, it's like this ROE gives us a big picture view of how effectively a company is using its shareholders' money to generate profits.
Okay.
But the DuPont analysis helps us zoom in and understand the drivers behind that ROE.
Oh, okay. So it's like breaking down a recipe into its ingredients.
Exactly. We can see which ingredient is contributing the most to the overall flavor.
I like that analogy.
So it breaks down ROE into 3 key components:
3 components.
profitability, efficiency, and leverage.
Okay, let's take a closer look at each of those.
Sure. So first we have profitability,
Profitability.
which is measured by the company's profit margin. This tells us how much profit they're making for every dollar of sales.
Got it. So a company with a high profit margin is squeezing more profit out of each sale.
Exactly. Then we have efficiency,
The efficiency, okay.
which is all about how well the company is using its assets to generate sales. This is measured by something called asset turnover.
Asset turnover.
A company with high asset turnover is like a well-oiled machine generating a lot of revenue with relatively few assets.
Okay, so high profitability and high efficiency both sound like good things. What about leverage?
Ah, yes, leverage. This refers to the company's use of debt financing.
Debt financing.
The company with high leverage is using more borrowed money to fund its operations, which can magnify returns but also increase risk.
So it's like using a lever to lift a heavy object. It can help you move more weight, but you need to be careful not to lose your balance.
Exactly. And the DuPont analysis helps us see how these three levers, profitability, efficiency, and leverage, are working together to drive the company's overall ROE.
Okay, so it's like seeing the whole picture, not just one piece of the puzzle.
Exactly. And Desai uses the example of Timberland to show how analyzing a company's performance over time
Over time.
can reveal shifts in their strategic decisions.
That makes sense. So we could use this DuPont analysis to look at Timberland's ROE over several years and see if they're becoming more or less profitable, efficient, or reliant on debt.
Exactly. It's like watching a financial story unfold.
This is so cool. I'm starting to see finance in a whole new light.
It really is fascinating when you start to understand the stories behind the numbers.
Okay, so we've covered the three main financial statements, the balance sheet, the income statement, and the cash flow statement. We've also talked about the power of ratios and learned about this cool tool called the DuPont analysis. But before we get back to trying to crack the code of this unidentified industries game, I have one more question.
Sure. What is it?
What about this concept of the time value of money? This site keeps mentioning it, and I'm still a little fuzzy on what it means and why it matters.
Ah, yes, the time value of money. It's another crucial piece of the finance puzzle, and it's actually pretty intuitive.
Okay, good, because I need all the intuition I can get.
The basic idea is that a dollar today is worth more than a dollar tomorrow.
I think I get that. Like, I'd rather have $100 today than have to wait a year to get it.
Exactly. But why is that what makes money today more valuable?
Yeah, I'm curious too.
Because money you have today can be invested and earn a return.
Oh, that makes sense.
So if you get that $100 today, you can put it in a savings account, invest in the stock market, or even start a business.
Right.
But if you have to wait a year to get that $100, you've missed out on a year's worth of potential earnings.
So it's not just about having the money. It's about having the time to make that money work for you.
Exactly. And this concept is crucial when we're thinking about valuing companies making investment decisions, or even planning for our own financial futures.
Right. We need to account for the fact that future cash flows are worth less than cash in hand today.
You got it. We need to bring those future cash flows back to their present value, and the discount rate we use to do that reflects the risk of the investment. A riskier investment requires a higher discount rate, which means those future cash flows are worth less in today's dollars.
Okay, so the time value of money is all about recognizing that money today has more earning potential than money in the future, and that's something we need to consider when we're making any financial decision, whether it's investing in the stock market, buying a house, or even just deciding whether to get paid now or later.
You're exactly right. It's a fundamental principle that underlies all of finance.
Okay, so we've got a good handle on the basics of financial statements.
Yeah.
We understand the power of ratios, and we've even demystified this concept of the time value of money. I'm feeling a lot more confident about tackling this unidentified industries game now, but before we jump back into that, there's one more piece of the puzzle I'm curious about.
Okay.
Desai talks about capital allocation and how it's like a company's strategic roadmap. Can you break that down for me? What exactly is capital allocation and why is it so important?
Sure. Capital allocation is essentially how companies decide what to do with the money they make.
Okay, so it's like their financial game plan.
Exactly. They have to figure out how to use their resources wisely to achieve their goals.
Makes sense. So what kind of decisions are we talking about here?
Well, once a company generates free cash flow, meaning the cash they have left after covering their operating expenses and investments, they have a few options.
Okay, what are their options?
One option is to reinvest that cash back into the business. This is what we call organic growth.
Organic growth.
Yeah, it could involve things like expanding their existing operations, developing new products, or investing in research and development.
So for Starbucks, that might mean opening new stores, coming up with some crazy new Frappuccino flavor, or maybe even buying a coffee bean farm.
Exactly. It's all about using their cash to fuel growth from within.
Makes sense. So that's organic growth. What other options do they have?
Well, they could also look to grow through mergers and acquisitions, or M&A for sure.
Oh, yeah. M&A, like when one company buys another company?
Precisely. It's a way for companies to expand their reach, gain new technology, or eliminate competition.
Like when Facebook bought Instagram.
Exactly. That was a huge M&A deal.
It was. So M&A can be a really powerful way to grow, but it can also be risky, right?
Oh, absolutely. Desai emphasizes the importance of careful due diligence when it comes to M&A.
Due diligence?
Meaning they really need to do their homework before buying another company. They need to understand the financials, the operations, the market, and make sure they're not overpaying.
So it's kind of like buying a house. You don't want to just jump in without getting an inspection first.
Exactly. You want to make sure you're getting what you're paying for in an M&A deal. That means thoroughly evaluating the target company before making an offer.
Okay, that makes sense. So organic growth and M&A are two ways companies can use their cash. What if they don't want to do either of those things?
Well, then they have another option. They can return that cash directly to their shareholders.
Return it to the shareholders. How do they do that?
There are two main ways to do this: dividends and share buybacks.
Okay, I always hear about dividends in the news, but I'm not really sure how they work.
Sure, dividends are essentially payments that companies make to their shareholders, usually on a quarterly
So
basis.
it's like a little bonus for being a part owner of the company?
Exactly. It's a way for investors to share in the company's profits without having to sell their shares.
Oh, that makes sense. What about share buybacks? How do those work?
When a company buys back its own shares, it's essentially reducing the number of shares available in the market. This can increase the value of the remaining shares and boost earnings per share.
So it's kind of like the company is investing in itself.
Exactly. It's a way for them to signal to the market that they believe their shares are undervalued.
Interesting. So we've got these three main options for capital allocation: invest in themselves, buy another company, or give the money back to shareholders. It seems like a lot to juggle.
It is, and that's why capital allocation is such a crucial aspect of finance. It's about making strategic decisions that maximize shareholder value. Sometimes it's better to reinvest profits back into the business. Other times, it might make more sense to reward shareholders. There's no one-size-fits-all approach.
It's like a constantly evolving puzzle.
It is, and it requires careful analysis and strategic thinking.
Speaking of puzzles, I almost forgot about our own unidentified industries game. Have we gathered enough clues to finally solve the mystery of these anonymized companies?
I think we've learned about the power of analyzing financial statements ratios
Yeah.
and even the DuPont analysis. Remember how we were intrigued by Amazon's unusually long receivables collection period?
Yes, it was a big clue about their unique business model, where customers pay up front, but they often delay payments to their suppliers that gave them a ton of cash on hand to fuel their growth.
Exactly. And remember those contrasting inventory turnover rates between Yum Brands and Nordstrom that helped us visualize how different industries manage their inventory based on their products and sales cycles.
Right. Fast food versus designer clothes, totally different approaches. But each makes sense in the context of their business. This game has been a fantastic way to bring these concepts to life.
It really shows how analyzing financial information can unlock fascinating insights into how businesses operate and create value.
Well, I'm feeling like a financial detective now. I
Pepper,
think we're ready to put all the pieces together and crack the code of this unidentified industries game.
let's do it. I have a feeling you're going to be surprised by some of the companies behind those numbers.
Okay, everyone, we're going to take a quick break, and when we come back, we'll reveal the identities of those mystery companies and see if our financial detective skills are up to par. As we wrap up this deep dive into the world of finance, I have to say, I'm walking away with a whole new perspective. I used to think finance was just about numbers, but it's really about understanding the stories those numbers tell. It's about seeing the connections and understanding how businesses operate and make decisions.
Absolutely. And it's about recognizing that finance isn't just something that happens on Wall Street. It affects all of us every day. Whether you're running a business, investing your savings, or just making everyday decisions, understanding basic financial principles can empower you to make smarter choices.
Mihir Desai's book has been an incredible guide on this journey. He does such a great job of demystifying complex concepts and showing how finance is ultimately about understanding information and incentives.
It's a must-read for anyone who wants to level up their financial literacy.
So the next time you hear about a company making a big acquisition, announcing a share buyback program, or maybe even just see a news story about the stock market, remember what we've talked about today. Think about the information they might be signaling, the incentives driving those decisions, and the underlying financial principles at play.
It's all about connecting the dots and seeing the bigger picture.
Well, that's a wrap on our deep dive into the world of finance. Thanks for joining us on this journey of discovery. We hope you've gained some valuable insights and maybe even had a little fun along the way. Until next time, keep learning, keep exploring, and keep that financial intuition sharp.